Let's bring in now Stephen Chubak from Wolf Research. Very good afternoon to you, Stephen. Thanks so much for joining us. I wanted to dive in on an area you were asking a question on the Goldman Sachs call about trading revenue for Goldman Sachs. To what extent do you think this huge performance we've seen for them in that area over the course of 2020 is just 1 year one-off versus structural gains that they may have made and that the industry may be seeing a corner turned on versus declining margins over the prior decade?
Yeah, thanks for having me, Wells. And no, it's a great question, and certainly one that we and investors are really struggling with, given 2020 IB and trading strength was so outsized. And the one thing that we're most encouraged by is that the street and the analyst community is already reflecting pretty aggressive normalization in IB and trading activity, which I think is appropriate. But what they're missing with Goldman specifically is the fact that this company has also transformed some of its initiatives on the trading side, which has enabled them to actually gain more market share than anyone else over the past couple of years. And that's something which I think is getting lost in some of the 2020 trading strength, where people are having difficulty unpacking that. What it ultimately boils down to is street estimates are too low. It means that there's probably about 10 to 15% upside to numbers. And so as people make those adjustments, the stock is going to continue to move higher from them.
So obviously it traded down 2% today. Do you see that as a buying opportunity, Stephen? And what's your price target for Goldman?
Yeah, I absolutely view it as a buying opportunity. I don't think the price action is representative of the discussions that we're having with investors that are much more constructive. I mean, even with today's sell-off, it's still the strongest performer year to date. It had come hit red hot. From our point of view, this is a stock where there's a credible case for a $400 valuation over the next 12 to 18 months. So right now, trading below $300, there's a tremendous amount of upside here.
Stephen, overall, banks stocks have come back at the beginning of this year and toward the end of last year as the value stocks have been in favor and have really started working. Where do valuations broadly stand right now? How cheap is this group relative to history and the market?
Yeah, so relative to history, they're still extraordinarily cheap. As you noted, they have started to recover off relative trough multiples, probably around July, September timeframe. You did have that rotation out of growth and into value, and the banks certainly benefited from that. But when I look at where these banks are trading right now on normalized earnings, which just assumes an economic reopening and relatively slow and steady growth, they're still quite cheap, probably about a 10% discount relative to history when I make those adjustments. But the earnings momentum is also improving pretty dramatically. So as you think about, NII starting to improve as the rate outlook improves, the credit outlook's getting better. Now the banks are allowed to return capital. And given that setup, you're going to start to see these earnings growth algorithms improve pretty dramatically. And ultimately, it's just going to translate into meaningful upside for the sector.
Wanted to come, Stephen, to Wells Fargo, which traded down fairly sharply on Friday, bounced a little bit today by 1% or so. You had a tactical call on them before earnings. What was that call, and what's your recommendation as we stand today?
Yeah, so tactically we were cautious on the name. We had actually upgraded Wells in September. I think at the time it was about 75% of tangible book. And our view was there was significant long-term upside because this is a company that, despite its challenges, still would be able to generate a 12 to 13% return over time. The problem is that's not going to happen overnight. And we knew that, as some of the analysts started to upgrade the stock at the start of the year, we felt like NII forecasts had gotten ahead of themselves, and management did the right thing. They reset the bar on earnings, expectations rebased, the stock sold off. And now I'm looking at the name and saying to myself, if I have even conservative assumptions around rates over the next 2 to 3 years, as they start to improve on driving efficiency savings, and there's a huge opportunity for Wells there, about $8 billion, and they've realized less than half of that. It feels to us like this is going to be a low 40 stock over time. It might take them a little while to get there, and some of it's contingent on having the asset cap removed. So that's the Fed limiting their balance sheet growth until they check certain boxes on the regulatory side. But ultimately, this is a stock with significant long-term upside. near-term caution, I think that's played out with the sell-off, and now I'm comfortable staying long.
Stephen Chubak, thanks so much for joining us.
Shepard Smith here. Thanks for watching CNBC on YouTube.